everyone's on the wrong side of the trade. The trade is people are bearish bonds and long equities. And we just experienced the worst bond bear market in like 80 years. The returns on bonds has been dismal. And the thought is that bond yields are going to go up. If our thesis works out, bond yields are going nowhere but straight down. All U.S. government Treasury yields are going to go straight down. And if our economic forecast is right, the Fed will be cutting and cutting and cutting and chasing.
Ed Dowd, founding partner of Phinance Technologies, which is a global macro alternative investment firm, and also author of the book Cause Unknown, The Epidemic of Sudden Deaths in 2021 and 2022. It is great to see you again, Ed, and great to welcome you back on the show. You are one of our most requested and most popular guests, so I'm thrilled to have you back on here in 2025.
Julia, great to be here. Thanks for having me on again.
Well, of course. And like I said, you're one of those most requested names that I get in the comment section. And I think your episode it's at least one of our top 5 performing of all time. So thrilled. We spoke, the last time we spoke was in June of 2024. And so much has happened. I was actually re-listening to that conversation. You made some prescient calls, which was just incredible, from how much the Fed would cut rates to the Japanese yen carry trade. I'm just calling out some of the memorable moments from that conversation. But I do want to start where we always start, and that is more with that big picture, more of that macro view, where we are today, the framework that you are looking at the world from. And as you know, Ed, you can take all the time you need to set the table when it comes to that big picture macro view.
Yeah, sure. So, before I came on your show, we at Phinance Technologies have a very rigorous early cycle indicators that predict recessions and where we are in the economy and recoveries and all sorts of good things. And we like other economists, our economic cycle early cycle indicators indicated a recession at the end of 23, beginning of 24. That never occurred. Our cycle indicator started to bounce. We thought it was going to be a false positive, but it bounced all the way up to a 0, which for us is not economic expansion. So we came from very low levels to almost expansion, but then we started rolling over again in 2024. And the reason, we asked ourselves, why were we wrong? And why have the laws of fundamental economics changed? Well, the answer is they didn't change. We saw something so unprecedented in the history of the United States. Combination of fiscal dominance, deficit spending levels that were crisis level. You got to remember the great financial crisis, we had 9-10% deficit levels to GDP. We were doing 8% in 23 and 24. And so we've kind of reverse engineered what happened, and it was unprecedented government spending, hiring, and the facilitation of 10 to 15 million illegals into the country. And that's been the economic variable and the elephant in the room. That's why a lot of economists got things wrong. It didn't grow the economy; it just kind of stabilized it. And there's been economic confusion. PMI and capacity utilizations indicate economic weakness. There's a disparity in the household survey versus the establishment survey, and so what we figured out was this phenomenon really juiced the economy, and everything Trump's going to do is going to reverse that out. It was unsustainable to begin with because you can't have $2 trillion deficits. You can't import 10 to 15 million people in a very short order of time without a regime change, which we got. The middle class was already experiencing what I would call a recession. So in 1980, Ronald Reagan got elected because real wages were minus 2%. Same thing happened for Bill Clinton in 92, and Trump had minus 2% real wage growth. So it was the economy, basically. So the only people that have been benefiting from the economy are the top 0.1%, those who own most of the financial assets in the country, and the very low end, the very poor, and the illegal immigrants who are coming in, getting accommodations and goodies from the government and the NGOs. And now we're learning there are a lot of revelations going on in the news today about how this worked. The government, to get things done that they didn't want people to see, they would dole out money to NGOs. Those NGOs that would then take their cut, and then facilitate this illegal immigration. So the economy was really held up and limped into the finish line in 24 by all this unprecedented spending. And everything that is going to happen is going to reverse out. The housing market is a big problem, we think. We just put out our first paid research report, U.S. Economy 2025 Dangers of a Deep Worldwide Recession. And it's for investment professionals and those who manage other people's money, family offices, high net worth individuals. So if you're one of those people and want to get a deep dive and look at the actual work that we did and all the way we get there, I encourage you to go to our website and buy it.
We're definitely going to link that. And we do have some of those folks, many of those folks, what I learned, it's funny when I learn who watches the show and it kind of blows me away sometimes. So yeah, we do have definitely that demographic as well. And we'll link that in the show notes. Okay. So you have this research report. You're talking about deep worldwide recession. Okay. Let me ask you this. So if everything was propping up the economy, under the Biden administration last year, all of these different factors, and if Trump is going to reverse it, let's talk about one, the recession bit, but two, is it possible that he could get blamed for a recession, or is there a way to message it and say, hey, we have to take a lot of pain because of, these activities and, kind of policies over the last 4 years?
Yeah, so I've been on some shows. I've been on Steve Bannon's War Room to try to get the Trump administration to understand what's going on in the messaging. Look, I think getting rid of regulations and, the tax cuts he's going to reinstitute, the 2017 tax cuts, they're good first steps, but it's going to take time to work through the economy because we've got this hangover pain coming. So, recession shouldn't be feared. And a recession, the way I'm framing it is a recession is proof that Trump is restructuring the economy for the middle class. If we don't see one and government spending accelerates, it's more of the same. We're kicking the can down the road, only making the inevitable crisis much worse. So that's the framing I would suggest to the Trump administration, that there is, and this happened to Ronald Reagan. There was a recession in his first 2 years of his term. And then when we came out of it, it was a roaring economy and he got reelected. Now, Trump can't run again, but obviously the Republicans and those around the Trump world, like J.D. Vance, would like an opportunity to, inherit a booming economy into an election.
Mm-hmm. But I imagine you have to take some of that, do some of the shorter term pain now for the longer term gain, right? If you have to, yeah. Okay. Can you just maybe flesh out a bit more of your thoughts on the Trump 2.0 administration and what these policies could mean for the economy? Would love to just hear more of the thesis.
Well, so like I said, immigration is the elephant in the room. Mm-hmm. You don't even need to deport the 15 million that are here already. If you see what the Trump administration is doing, they're freezing all sorts of spending right now. They're examining everything. So spending is being frozen to all sorts of NGOs, USAID's under investigation. So the spending is being examined, it's being cut off. But before Trump even took office, there were self-deportations. A lot of illegals started to just leave because they knew the writing was on the wall and their free lunch. Not all of them are bad people. There are some people who wanted to work, and you have to, there's people that came in genuinely wanting to get a job. A lot have not, but a lot of people are self-deporting. And, this is kind of complicated, but the housing market has been stagnant. New supply of new homes is almost back to 2007-8 levels. So, and permits are decreasing. So that we're going to have a correction in the housing market at some point. And housing mortgage rates are too high. So there's no transactions. The real estate market is dead at the moment. Mm-hmm. And what's going to clear that is price. And what's been holding up the real estate market has been massive accommodation. When you import 10 to 15 million people, that helps those who have rental properties. The government pays the illegals, and the illegals pay the rental property owners, both single family and multifamily homes. What happened in the fourth quarter? And we put out a follow-up report to our big report that the subscribers can get for $1. It's basically for our subscribers. But what we found is new tenant rents plunged in the fourth quarter, just absolutely cratered. And that's a leading indicator for the average rental index. And so when you look at how inflation numbers are calculated, it's like 30+% of the CPI number is the housing of the country. And when you see what's going to happen, the leading indicator, new tenant rents, we're not going to be talking about inflation come the summer. And you know, if you read our report, everyone's on the wrong side of the trade. The trade is people are bearish bonds and long equities. And we just experienced the worst bond bear market in like 80 years. The returns on bonds has been dismal. And the thought is that bond yields are going to go up. If our thesis works out, bond yields are going nowhere but straight down. And treasury, all U.S. government treasury yields are going to go straight down. And the Fed's going to chase this all the way down. And if our economic forecast is right, the Fed will be cutting and cutting and cutting and chasing.
What if you can grow your gold so you're not just preserving, but you're growing your wealth in an asset that can't be inflated away by money printing? Monetary Metals lets you do just that. You can earn 3% on gold, paid in gold, in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even as high as 19%. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. Okay, you know what? That gets my attention too, especially hearing you as someone, you came from the world of like being an equity fund manager as well, and people have the trade all wrong. Question for you. Why do they have it wrong? Are they getting the inflation story wrong? Like what is it that they're missing?
Well, so, you know, there's two types of Wall Street is silent. So when I was at BlackRock, I was an equity portfolio manager, but I came from a fixed income background. I worked at HSBC as a bond salesman. So I had the ability to kind of look at both sides of the trade. And a lot of my greatest calls were looking at bond markets, telling me equity markets would follow. So what I'm talking about is mostly asset allocators. The amount of bullishness in the stock market and the amount of money being allocated to equities is quite high and to bonds quite low. And so as this trade unwinds, there'll be a giant sucking sound from equities to the bond market. And Scott Beston, who's wants to refinance, Janet Yellen did a lot of front-end loading of the Treasury.
The short term issuing of the short term paper, right?
Yeah, correct. And so that's third world behavior. And so people have been saying, well, there's no way we can sell those bonds because everyone's selling treasuries right now. Well, that's going to reverse in a recession. So Scott Beston's going to be able to term that out longer term, and a recession would help him term that out. It's actually, I think that's how it's going to play out. Once the general market, if we're right, if our thesis is right, once this begins, it'll be quick and fast.
Okay, so you think this sell-off in the general stock market will be fast? Can we explore that? Is it because of the massive passive bid that's out there too that would be the accelerant, or just kind of curious?
Well, so in the old days, when I was running money at BlackRock, 70% of the equity money was run by fundamental investors, meaning portfolio managers and or private investors. 95, that's the trend since I left, and the trend was already underway when I was at BlackRock. There was a trend from fundamental active investors to passive. The stock market is now comprised, the volume, like I said, it was 70% fundamental investors back during the great financial crisis. The volume now is 5% fundamental investors, 95% passives and algorithmic trading. So that's the case could be made that the stock market, which used to be a good indicator, a leading indicator of the economy, isn't so much anymore because a lot of the headline numbers have been strong GDP, the employment numbers. There's been a lot of controversy about the employment numbers and thoughts that they've been padded statistically. There is some proof for that. There's something called the QCEW, the Quarterly Census of Earnings and Wages, which is kind of the reality. In my whole career, we never cared about that report because you didn't need to, because the difference between the non-farm payroll, which is the estimate and by the way, these reports are done by the same agency, the BLS. They usually, net it out to zero. Well, it came out, the last QCEW came out in June, and it was a 7 sigma difference from the establishment survey to the tune of 1.25 million jobs. So we talk about that in our report, not the QCEW per se, but we think that the difference has been illegal immigration and the real average American is having a difficult time finding a job. And these have been low-end wage jobs.
Mm-hmm. I want to come back to that too, because you did bring that up on the last episode. But just this notion of if you see the sell-off and it's going to be really fast too. Does that? And you mentioned at the top, recession. Okay.
When I say fast, I don't want people to think it's crash. I mean, there's 2 ways this can go. This can be we're not thinking this is going to be systemic. Systemic is when you have a plumbing issue in the credit system and things, you have, just collapses all over the place. The 2000 recession was more of a 50% drawdown in the stock markets over 2 years. So it could be combination. It could be slow like that, fast if we go systemic, or a combination of the two. But once the trend reverses, you still got time to make, realign your portfolios. But I think it's going to be quicker than we think.
But just going at the top, you mentioned that recessions aren't necessarily something to be feared. So I'm asking this, could it create an opportunity, maybe a bit more of like a generational opportunity, like for, I don't know, entry point for folks? I don't know. If
people are always looking at stock market corrections and housing corrections as bad. They're not necessarily bad unless you're over levered and up to your eyeballs in debt. Now, the good news is most millennials want to buy a home.
I want to buy a house so bad.
Yes.
So bad.
Millennials want to buy a home. They'd like to be able to invest at lower stock prices, not at generational high valuations. That's why Warren Buffett's out of the market. He's not stupid. So this creates a huge opportunity for it's a transfer of generational wealth, essentially. And it needs to happen, quite frankly.
Yeah. I got a viewer question recently. It was a really long email, but maybe I'll see if I can condense it down a bit, because you might be a guest who could answer this. First of all, are you someone do you have dry powder? Are you one of those folks who are kind of waiting for opportunities by any chance?
Yeah, that's what I've been recommending. Look, I was early. I've been saying for the last year, I had some dry powder. So that call's been a little early.
Okay. Well, I got this really nice email from this guy. Shout out Michael in New Jersey. He said I remind him of his daughter. So I remember this email and I'm like, I have to pull it up. He said a number of your guests have mentioned that they are sitting on dry powder, waiting on good opportunities. They also talk about the possibility of extended down market conditions. They point out time periods in the past where they profited by buying in down markets. So he has a few questions. You don't have to answer them, but if there are any that are relevant. He said, what are some examples of companies or industries that were bought in previous down markets? And what were the circumstances that caused them to buy those industries? Same questions for the next downturn. What are the signals that it's time to start buying? PEs declining to a certain point or range, price percentage declines, et cetera. When they start buying, do they wait in over time periods of months, years, et cetera? If they're 50% liquid, what conditions determine the speed at which they deploy capital into purchasing assets? He just asked a bunch of questions, but if there's anything in there that you'd like to pick, it might be nice to answer, because I love my audience and I love when they write in. So if there's anything that's relevant to you, that you might be able to share.
Let's say you already have dry powder. If you're sitting on dry powder, then you have to figure out when you redeploy, right? That's, when you redeploy. And without trying to pick, there's a couple ways to do it. Not trying to pick the bottom. So if the market goes down 30%, maybe you throw 10% back in of the dry powder, and you kind of, at dollar average in, knowing you're not going to pick the bottom. but you're getting, overall you're buying at lower and lower prices. Or if you're more of the person that wants to pick the bottom, which is very difficult, typically speaking, bottoms are marked by huge volumes of selling and awful headlines that the world's coming to an end. The other thing you can look at is you can look at different stocks and industries if you want to be more adventurous. Back in the great financial crisis, things were awful. We were scared, even those of us who manage money were fearful. But you have to kind of overrule your emotions. And there was this one point when NVIDIA, before its current, incantation of AI, reported down 50% revenues and down 50% earnings. And the stock was down, I think, around $2.70. And the stock didn't go down on that news. So that's an indication. And I remember talking to a friend of mine. We bought the stock hand over fist, even though it sounded awful, because how much worse could it get than that? That's kind of, it's the second derivative. So this is so bad. It's going to get better at least over the next year, somewhat. And then the stock took off, throughout all of 2009. So there's a bunch of different strategies. For the average person who has a job that can't monitor this every day, I would just, start with 5% increments. And, if we're right, we get a correction, just start slowly reallocating money in until, you won't catch the bottom, but you'll be better off than 99% of the people who are all in.
Well, thank you for answering that. And folks, feel free to write in anytime because I love hearing from you all. Okay, I want to go back to the topic of immigration because when I listened to our old episode, you did bring it up, and I guess I didn't really go there with you or go deep with you. And maybe it's because it is a hot button issue. Do you think, I want to hear more on your thesis there around it. It is an economics story. Do you think it's one of these stories that doesn't get talked about quite enough? I'm thinking purely from more of what it means for the economy side of things because it is such a hot button issue. Just curious,
Well, I think a couple of things. We didn't know, it didn't dawn on us immediately. Mm-hmm. And I think we've always known that since Biden got in, that there were things going down at the border that were nefarious and strange. And the mainstream media locked down any reporting on it. So it was difficult to get information. So you had to go to the alternative media. And then we started doing our own research and we looked at, so in our report of the actual numbers. The official numbers are 10 million border encounters over the last 4 years, with 23 and 24 being some big ones. That's just border encounters. That's actually contact. People slip through without contact. So we say 10 to 15 million. It could be more. In the back of your mind, it wasn't all over the mainstream media. Mainstream economists probably weren't thinking about it. So it kind of, for a year or two, it went under the radar, but that amount of people. So legal net migration is normally 1 million a year. So we had 10 to 15x that in, 4 years. That is just a game changer economically. And we're going to find out, and I believe, and it's starting to come out already, that this was not just, they came over the border and they had no money and they figured out, how to make ends meet. This was a very purposeful plan done by the government. You can call it the deep state, the bureaucratic state, the administrative state. It was a policy that required billions and billions of dollars. And a large part of our deficit spending, we'll come to find out, was doled out to these illegal immigrants in different ways. Sometimes direct benefits, sometimes NGOs, getting money to get them in here and putting them up in housing. So this is a big new economic variable that I think is the elephant in the room.
Mm-hmm. Did it translate to an increase in the velocity of money? Were there other signposts?
Yes, the velocity of money took off under the Biden administration. It had been trending down for decades, and it took off. So when you give money to someone who spends it immediately, that increases the velocity of money, and that is going to go the other way. Absolutely the other way. And if you look at, since Trump's gotten in there, border encounters have dropped. There's all over X. There are charts of border encounters, they plummeted. So this is the second derivative thing going on here. You don't even need to deport anybody. It's the flow has stopped. And like I said, new tenant rents have plunged. Now, that is a very volatile economic variable. It may bounce back up, but it was such a big move. We think it's early signs of our thesis starting to play out.
That is interesting because that ties into inflation. Okay, I'm going to kind of pivot though just a bit here because a lot of it's interesting because I feel like you're kind of highlighting narratives that aren't being shared, right? Like you're not seeing in like the mainstream per se. Well, you're not seeing them there. So I'm just thinking out loud, this is my terrible segue into it, but one of the other narratives that you see in the mainstream around inflation is around tariffs. Do you have a different take on tariffs, and are folks getting that narrative wrong? Because it sounds like we're going to see a different story when it comes to inflation.
Yeah, tariffs are a negotiating tool. If you remember back in 2016 through 2020, there were a couple spats with tariffs used as a cudgel. And they affected the stock market for a day or two, and then the stock markets would always bounce back. It was called the Trump effect. Day traders hated him because they'd have trades on. He'd say something and they'd be blown out of their position. But these are day traders. People who actually, are investors, don't care about short-term noise. And let's just look at the most recent experience. He came out with these like 25% tariffs, and within 24 hours, he started to back off on them because he got concessions. So it's the art of the deal. Trump uses it as a negotiating tool, a cudgel. And quite honestly, because of the size of the trade deficit right now, we have all the negotiating power because we're net importers, and he wants to fix that. So I don't think that, and again, whatever tariffs are implemented that actually stick because someone doesn't budge on the other side of the sea or the table, it's going to be dwarfed by what's coming from all the government juice that we saw the last 2 years reversing out. It'll overwhelm anything. Tariffs are small. We won't even be talking about tariffs in a couple months if our thesis is correct. It's just kind of a side issue.
Mm-hmm. Yeah, Dr. Art Laffer said the same thing a few months ago. He said it's a negotiation tactic, like you point out, art of the deal, if you will. Okay, you mentioned also at the top of the conversation, you said, okay, a lot of the juicing that we've seen in the economy. You mentioned fiscal dominance. This is a topic that has come up on this show. We had Dr. Charles Calamiris. He had that paper with the St. Louis Fed. It was over a year ago now. Lynn Alden has talked about this topic. Luke Groman. I want to hear more on the fiscal dominance. And do you think, are we going to get out of that?
Well, we have to, because unless we do, the government is very inefficient at allocating capital, and they're sucking up when you have fiscal dominance, you crowd out private investment. And so what the trick for Trump is to get us out of fiscal dominance, get the economy going again so that, the private sector starts to build, invest, confidence rises, money velocity doesn't crater anymore because there's deregulation and tax relief. So that's kind of the trick. There's going to be that. And so it's a delicate balance. That's why if Kamala Harris had gotten in there, we'd be extremely bearish. We're just saying it could be a deep worldwide recession, but we're not in our report. We don't call for it to go systemic. So it could, and if it does, we'll talk about it then. But so this is kind of a normal recession. We're due for one, and it's not necessarily a bad thing. And so that's basically it.
Mm-hmm. Do you think it's people are fearful of recessions because they have like a bit of that recency bias? Like, I don't know. I just think back to like 2008. I remember that when that happened. Like, I remember exactly where I was like when Lehman failed. I was in college, but how crazy is that? Like, I still remember that felt like a big deal, or at least the impact of it felt a big deal, like to adults, for example, and then going into the job market after college. But is that why people are fearful, because they remember the most recent?
Well, white collar workers are fearful because they remember the great financial crisis, because a lot of that affected white collar more so than the average Joe. Because I remember being in the midst of the great financial crisis in Disneyland with my kids and my now ex-wife, and the average person had no idea what was going on or cared. The biggest fear for anybody in a recession is, especially if you're middle class and don't have a lot of assets, is losing your job. And what's going on right now is the great financial crisis for the bureaucratic state. I mean, people are losing their jobs. I think this is a great financial crisis for people who haven't been productive members of the economy. And they're getting buyout deals. I mean, they're going to get 8 months severance or whatever it is. And so that's they're not being thrown out into the streets. So it depends on where you are. In the financial markets, whenever there's a correction, there's always, job losses in the financial sector, but no one really cries for investment bankers or traders, or no one really weeps for them.
Yeah. Okay, that's kind of an interesting point too, because when you think about productivity, what if you can get those folks in the private sector doing something more productive versus these bureaucratic jobs? Could there be an opportunity maybe after the 8 months? I don't know, but is there a silver lining to that, reducing the size of the bureaucracies, getting people out there?
It's an unknown. You have to have faith that with what we're seeing with AI, what we're seeing with, and I think there's obviously an AI bubble, but we'll talk about that. But AI, getting rid of the waste and the debt issuance that's sucking up all the private capital, it's going to be a tough transition. But you're going to have faith that when people are put their backs against the wall, they'll take opportunities to be more productive and be more creative in their lives. I mean, adversity does make people more productive, those who have skill sets and take risks. And especially in a deregulated environment, a lot of new small businesses will be created in the depths of the recession.
Mm-hmm. Yeah, that's a good point too. Okay, you mentioned AI bubble. Let's hear it.
Yeah, so that's not even part of our, thesis. That's just something that's going to happen. So I mean, I put out an X post 2 weeks ago. I said, "Hey, in 2000 we had a tech bubble, and in 2008 we had a housing bubble. What do you say we slap the two together and see what happens?" And we think the housing crisis that's coming, we don't think is going to be as bad as 2008, 2007, but it'll be painful. But we also have 7 stocks comprising 40% of the S&P index from a market cap standpoint, very narrow market, and it is what it is. There's been a huge infrastructure build in AI. There's no revenues on the other side. This reminds me of the .com bandwidth boom. There was a ton of bandwidth being built with junk bonds, but no customers on the other side. That all those companies went bankrupt, WorldCom, Windstar, and that all that bandwidth didn't disappear. It was bought up for pennies on the dollar. And then we had the Web 2.0 companies come, like Facebook and X, and Amazon rose from the ashes. So I expect the same thing in AI. And we just saw this DeepSeek. I'm not sure you're familiar with what's going on there, but DeepSeek.
Oh, yeah.
DeepSeek basically blew up the economic model of it doesn't take the amount of capex and power if you do it a little more smartly. Now there's a lot of controversy over that, and this is going to happen anyways. You cannot have the costs of AI being so huge without revenues on the other side. You would see bankruptcies eventually of some of these AI companies, and then pricing would come down, as it always does. Semiconductors are cyclical business. The prices of NVIDIA chips will collapse, and then we have a boom after that. But the AI bubble is an infrastructure bubble, much like there was a railroad bubble in the 1870s. Infrastructure build, bankruptcies, then cheap railways. Utility boom in the turn of the century. Lots of speculation and hype, infrastructure build, bankruptcies, and cheap pricing. It's kind of part of the cycle.
Got it.
So long term, it's a good thing.
Yeah. Lowering the cost as well. Okay, but that's not part of like the big thesis, the research that you have. And I don't want you to like spill all the goods that are in the research, but I want to ask you this because this audience, they love like hearing from guests on this topic. Okay, so let's say we have the recession. Where else do you want to be? Do you want to be in like a safe haven asset like gold? Is that something that's interesting to you?
Well, look, gold, I'll just go off of what my previous experience has been and not making a call, but maybe issuing a slight warning. Gold anticipates crises, and it did gold had a very big bottom at the end of the dot-com boom. Then the Fed started printing tons and tons of money that fueled the real estate crisis. Gold anticipated the crisis and started shooting up because of all the money in the system. And gold had a great run. In the great financial crisis, gold went down 50%. But that was a credit event. That was a systemic issue. And so there was a margin call, and you sell what you can, not what you want to, right? So there were no bids for certain assets in there. And so gold went down 50%. I don't think gold goes down 50% in this, but I think gold will. And gold traditionally doesn't do well when the Fed starts cutting interest rates. That's just a historical correlation. And so as the Fed accelerates their interest rate cuts, gold will have some hiccups. But again, maybe this time's different. But gold. A lot of people feel like the U.S. dollar is going to die. I don't know if anyone's looking at the U.S. dollar. It's going straight up. And by the way, when there is a recession, there's always a flight to safety. And there will be again in U.S. Treasuries and other sovereign bonds around the globe.
Okay, so that there'll be a flight to U.S. Treasuries. What would that mean for the U.S. dollar then?
Well, once the crisis starts happening, the Fed starts cutting rates, the U.S. dollar will initially take a hit, but then subsequently after that, it could probably start rising again. But it won't take a big hit. It'll take a hit because of people selling equities, repatriating their money, then buying bonds. It's kind of confusing, but the dollar's not going to collapse anytime soon.
Okay, let me ask you some more clarifying questions too. So because I mentioned you nailed the first rate cut call last year on this show, you said 50 basis points. Not many people were saying that either. When do you okay, obviously you're expecting rate cuts when this crisis hits. Are you expecting them before, like even the March meeting even?
Yeah, so the only way we'll know that is just watch the T-bill market. The T-bill is the Fed usually chases the market. That's the little unknown secret on Wall Street. The Fed, the market forces lead the Fed and the Fed cuts. The T-bill right now is at, I think, 432. The
442 right now. Yeah, I see 442 right now at 5:05 p.m.
Okay.
Yeah.
And so basically,
I haven't clicked in on.
So basically, if it starts to run again before the March meeting and get to a 50 to 75 basis point differential from Fed funds, that'll indicate what the Fed's going to do. So that's for me. Forget the Fed's futures market and all the speculation about rate cuts. I just follow the T-bill.
Got it. This is like my naive question, but like with the Fed, when they were cutting like last year, why did we see the yields go up on like the 10-year?
This happens all the time. So in our report, the yield curve was inverted for the longest period ever. Then it uninverted typically what happens when the Fed starts, there's a plateau, there's that interest rate hike cycle, then a plateau period, then a rate cut cycle. When they start cutting rates, the yield curve starts to steepen. And that's an indicator. It's called the normalization of the yield curve. That's a very strong statistical signal that a recession's coming, and it's normalizing right now. So it's anticipating a recovery now down the line, but recession first.
The yield curve is, yeah. Okay, so we had Professor Cam Harvey on late last year, and he is not, calling it a false signal yet. So Yeah, because it's a basic. I think it's 8 for 8 as an indicator, the inverted yield curve indicator.
Well,
So
this is confusing to a lot of people. It was inverted forever, but then the real strength signal comes from the normalization that just happened. So now,
oh,
again, it's not a timing tool, but it's even stronger signal than inverted. It's inverted, but that's not a timing tool at all. Like I said, it stayed inverted for like the longest inversion we've seen in a long time. Then once it normalizes, that's the countdown. That's when the strong signal occurs, and that's in our report.
that's interesting. Okay. This is why I love this show, Ed, is because I get to talk to folks like yourself and learn these things. And I appreciate you just answering my questions because I'm not an expert at all. I just love, trying to talk to the brightest minds and learn along the way. So I'm really, really grateful for that. Um, okay, so don't be fearful of a recession is another thing. There are opportunities, or there will be opportunities. Um, I guess in this recession, who is going to get hurt the most?
Uh, well, who benefited from the last 2 years of funny juice? It was the very, very rich
Hmm.
and the very, very poor immigrants. Those are the two. So the middle class is going to ultimately benefit the most from this. There'll
Yeah.
be some people who are, exposed as swimming naked when the tide goes out. People who are over levered up to their eyeballs in debt will experience great margin calls. But I mean, don't weep for them. One thing we have to worry about is a banking crisis. Some banks, I think, are going to fail, but as long as the big ones don't get into trouble, we'll be fine. I mean, we have they're already underwater in their held to maturity account, and that was why we had some bank failures in 23, Silicon Valley Bank,
Hmm.
because they were underwater from the interest rate hikes. The Fed came in
Yeah.
and did the bank term funding program to kind of, provide liquidity to the banking system for people and stop the deposit run. That worked better than I thought. So that was a good job on the Fed's part to prevent bank runs. But what the Fed's not going to do is bail out banks for bad credit. So we've gone from, bond duration losses on banks' balance sheets to the credit part of the cycle. And we already know there's a commercial real estate problem. The Fed put out a report in November, the New York Fed, saying that banks are extending and pretending. So the Fed is aware of what the banks are doing. Now, Trump's inheriting an economy where banks have been lying. And so there will be some credit issues. Just as long as they don't go systemic, we're fine. Now, if it goes systemic, Katie barred the door.
Oh, yeah. Okay. Another topic I want to bring up with you, just because it just remind me, when you think about the state of the economy and the jobs data last year with all of those revisions, it makes me wonder, like, one, how can you trust the data? But two, like, how is the economy really?
It's not good. I mean, if you look at a host of other indicators, not official government statistics, there's a lot of indicators to suggest we have a weak economy right now. And PMI, capacity utilization, household survey. The disparity between the household survey and the establishment survey has never been bigger. So you could make the case that the middle class has experienced a recession, but the overall economy, due to the unprecedented government spending, kind of kept it afloat from a headline standpoint. And there's been a lot of controversy about the establishment survey. Zero Hedge and others started calling this out at the beginning of 24. And that's been proven recently by the disparity between the QCW and the non-farm payroll, a 7 Sigma event. So you could say, and I've said publicly, it's either bureaucratic incompetence or fraud or a combination of the two.
In our past conversations, Ed, our past conversation before this one, we did talk a lot about the debt problem. And I'm looking at the US national debt clock, which actually has a Doge clock on it now, which is pretty neat for folks who have not seen that. But looks like the Doge clock is at 61 billion. But just looking at the US national debt, for example, and I'm not even talking about the off balance sheet, but it's 36.4 trillion and ticking higher. The last time you and I spoke, it was, I think, 34 trillion, around that area. Do you think, like, well, one, when do you think this will be a problem? But two, do you think we'll be able to start to really address it, or at least have that conversation and make some sort of changes for the future?
Well, so a couple things. If Doge, early days on Doge, I'm quite happy with what I'm seeing. I was happy to hear them talk about $2 trillion. I didn't quite understand how they were going to do it. I didn't realize they get the kind of access they have and the numbers that they're already saving. Elon has indicated he thinks he could save $1 trillion by the end of 2026. That would be great. If we can reduce the deficit spending, the bond markets will start to. If we can show proof of concept, the bond markets will start to anticipate that. And the U.S. is much better off than other countries.
That's true. Yeah,
believe it or not. So
the cleanest dirty shirt in the laundry pile.
Correct. So if we can just, the markets are always second derivative focused. So when people look at the absolute debt, 120% of GDP or 123 or whatever it is now, and they freak out. All we have to do and show the markets is that growth is going to plateau or slow or even go decline. And if we can show proof of concept, the bond markets will anticipate that, and interest rates will come down on the long end, which will affect mortgage rates. And then it'll be easier to invest. But prices and homes are going to come down first, then interest rates, then the economy will pick up. People will start purchasing homes and buying homes once prices come down. Right now, if you talk to anybody who's tied to a real estate business that relies on transaction volume, they're not doing well. They're just not doing well. There's no activity.
Yeah. I noticed that when I do my run in the morning, I'm noticing I see more for sale signs, but they've been for sale for a while. So days on market is quite high. That's an early sign. And the prices are really high too. I'm like, they're very high. Okay, so as we wrap up here, I'm going to ask you two questions. Okay, let's start with the first one. What is something that is keeping you up at night these days?
So we've always talked about the sovereign debt crisis, and and I've been saying for years, the release valve is currency. Mm-hmm. And what we saw with the Bank of Japan is a problem. The Fed, every cycle, rate hiking cycle, the Fed breaks something. They've broken the Bank of Japan, and there's been moves behind the scenes to stabilize that and reduce the volatility of the Japanese yen versus the dollar. And Japan is faced with a Hobbesian choice. They can either raise interest rates in the face of the Fed lowering interest rates to stabilize their currency, but blow up the yen carry trade that's been, in effect for a long, long time. Or they can, save the yen carry trade, because the international world wants them to, and destroy their currency and have a, inflation, hyperinflation. So we're at this nexus of, we had central bank coordination since the Great Financial Crisis. The U.S. Fed, the ECB, and the Bank of Japan. Those are the three major ones. And with the ECB being the funder of the yen carry trade because they had zero interest rates for decades. We're at the point now where one of the central banks has to buy out potentially because of it's save the global financial system or save themselves. So that keeps me up at night. A currency crisis, a real currency crisis in Japan.
And let me ask you just one quick follow-on, because I was looking at, again, like our old conversation, you talked about the Japanese yen carry trade too, and we saw that happened in August, I think, of last year. I'm trying to think of like what month. Okay, is that kind of symptomatic of like some of the underlying issues?
Symptomatic how?
Or just like, is it like a warning sign, or when we saw the Japanese yen carry trade unwind, or is that
it unwound a little bit? But there was a lot of liquidity provided. There were some. There should have been some people that there should have been some brokers that went bankrupt, but they mysteriously didn't. So there's been a lot of behind the scenes, like plugging holes to keep the system from going systemic. But long term, the ultimate release valve is currencies. And another thing that should alarm people is dollar liquidity is kind of drying up. And you can tell because the US dollar keeps rising.
That's interesting.
That's one of the reasons the dollar's going up. Also, there's other reasons. Currencies move for a host of different reasons. But when you see a relentless strong dollar, often it can point to dollar liquidity being a problem. And I think if you look at the GDPs of the other countries, we were the one that stood out. That mysteriously, while everybody else had declining GDPs the last year or two, or flatlining, the U.S. had 3% the last couple of quarters. Something's off there, and I think the juice was a big part of it. So there is pain across the ponds in different economies.
Interesting. Okay. Well, okay. So looking at currency is the release valve. That is the thing to pay attention to.
Yeah.
And for maybe the lay person, how can they do that? Like, what is the best way to do that?
You can go on investor.com. They have FX currency pairs, but generally speaking, currencies are boring, and they should be boring. But when you start hearing in the mainstream media about ginormous moves in currencies and volatility of greater than 1% in a day on a move in a currency, that's usually a 3 sigma event. That's when you need to pay attention. Monitoring it every day is probably a waste of time.
Yeah, for sure. But yeah, it was just interesting. That's why I was like, I had to ask you because when I re-listened to the episode, I was like, oh, I wonder if that, like, you were onto something there that I didn't understand at the time. Well, I still don't really understand fully, but that's why I wanted to bring that up with you.
And the other thing, the yen carry trade, a lot of people think it's an equity thing. It's mostly a credit thing. Most of the yen carry trade is borrowing in very cheap Japanese yen and then buying yielding pieces of paper in other countries. So it's a bigger credit issue than it is a equity issue. But the equity markets are what everybody keys off of. Mm-hmm, but if the credit markets freeze, the equity market will respond quickly. That's what happened in the Great Financial Crisis. It wasn't the equity market that caused it. It was a freezing of credit due to the bad bonds in the subprime. And everybody stopped trusting each other. And once that happens, that's what we call systemic crisis. We're not there yet. We're not calling for it because we don't want people to freak out. But if we see it, we'll call it out if we see it.
So we are going to be very clear, not systemic in this one.
No, just a recession. Okay. Just a recession.
And those aren't necessarily to be feared either. Okay, right. Let me ask you this. What is something you're optimistic on in 2025 going forward?
Well, I'm just tickled pink at all the revelations of things that are going on in a whole host of different areas. I mean, we're finding out that we've kind of been living in a matrix of a created reality. We're now finding out that USAID has been a piggy bank for government, clandestine government operations, censorship bureaus, paying mainstream media firms directly. I just think we're going to learn more and more about what's been going on the last, and this is not just an Obama-Biden thing. This Bush did it. The two Bushes did it. There's been this kind of behind the scenes piggy bank fraud going on for a while. The revelations, I think, are quite helpful to the country. And if we can, really reduce government spending and reallocate, the government's, there's a crowding out effect. Because when they issue treasuries, people will buy that, and there's only so much money to go around. So if you reduce the amount of government debt issued, it leaves room for private credit to expand. In the short term, as you reduce the government debt, it will cause a recession because that's the only thing been holding it up. But long term, it'll get into the right hands, and I'm really optimistic about, a potential golden age. Potential
golden age. Well, I have to say, Ed Dowd, founding partner of Phinance Technologies, and that is with a PH for finance. I want to give you the final minute here. Let folks know where they can find more of your work, the research report for folks who are more institutional as well, and any parting thoughts, anything that you would like to leave this audience to think about. The floor is all yours.
Yeah. First, I'd like to say that don't be in fear. I mean, again, this is going to create opportunities for those who have the right mindset. And also, it's necessary and will be proof that Trump's restructuring the middle class. So those are the two big frameworks I would like to get across. The report can be found at our website, financetechnologies.com with a PH. Right at the top of our homepage, we have the product page. You can go right to it. In the product, you get a full 85-page report detailing our analysis and our thesis. You get a executive presentation for anybody who wants to just review it quickly. And then you get a video of Carlos and I going over the executive presentation. And we plan on having follow-up reports. We already have one. And to our subscribers that buy the first report, it's available for just $1 to them. Yeah. And the follow-up reports can be bought individually, but without the full report, it's kind of, you're not going to get the full context.
The last time we had you on, you had another report around GDI went up under the Trump administration 1.0, I believe.
Yes.
That was a fascinating one too.
Yes. No, so that's the hope. And under the Biden administration, gross domestic income on a real basis for middle class went down. Obviously, inflation being a big part of that. We're hopeful that if he restructures the economy appropriately, we'll see a shift from the very wealthy to the middle class, and that'll be transmitted via financial assets.
Yeah. Well, Ed Dowd, founding partner at Phinance Technologies, that's finance with a PH. Thank you so much for being so generous with your time, all of your ideas, your knowledge, your wisdom. You're an absolutely incredible guest. We love having you on this channel. You're welcome anytime. Thanks again, Ed. Really appreciate you.
Thank you, Julia. Great to be here.